Good morning, everyone, and welcome back to the Daily Hunt for Multi-Baggers. Hope you all had a fantastic weekend.
Absolutely. We're here to kick off your week Monday, November 17th, with our AI-generated insights from yesterday's market chatter.
That's right, our algorithms have been busy sifting through a good number of posts from Sunday, flagging quite a few different stocks. Overall, the sentiment out there feels a little polarized. There's a lot of optimistic talk about future growth and catalysts, but our deep dive into the numbers often tells a different story.
Precisely, Ethan. It's that classic push and pull between enthusiasm and fundamental reality. We've got some interesting cases today where the market discussion really highlights that disconnect, especially when it comes to risk versus perceived potential.
So let's jump right into it. First up, we saw some activity around a ticker symbol RSI. Now, this one was a little unique, Brooke, because the social media discussion was largely focused on the relative strength index indicator itself rather than the company, Rush Street Interactive.
That's right, Ethan. And it was quite a strong bearish sentiment, but against the indicator's reliability, not the company's prospects. It's a good reminder that you really need to understand what people are actually discussing. But when we strip away that confusion and look at Rush Street International, RSI, as a company, the KPIs are what truly matter.
True. And at first glance, the company does show a strong revenue growth rate, nearly 89% year over year, which is definitely something to get excited about for a growth-oriented investor.
It is, Ethan, but that's where the optimism needs to hit the brakes. While revenue growth is healthy, we're looking at a PE ratio over 66, which is incredibly high. Even more critically, the company has a negative operating margin of nearly minus 10% and a low net profit margin of 2.8%. This tells me that their core business isn't profitable right now. Plus, its beta is 1.658, indicating very high volatility.
So despite the strong top-line growth, the operational efficiency just isn't there yet, making it a higher risk play, especially with the current valuation. It was previously rated stay away back in October.
And for good reason. Given that high PE, negative operating margin, and high volatility, the data still strongly suggests a stay-away classification. It's just too much risk for too little current operational stability.
All right, stay away for RSI. Next up, a big name, Netflix, Inc., ticker NFLX. There's a lot of bullish chatter here, Brooke, largely driven by the anticipation of a 10-for-1 stock split. Users are expecting a post-split rally, increased retail accessibility, and, they're really confident in Netflix's content strategy and subscriber loyalty. They're talking about a best-ever content lineup.
And I get the excitement, Ethan. The underlying business is solid. Netflix has impressive revenue growth at 17.2, a strong net profit margin over 24%, and an excellent return on equity at 42.8. These are fantastic operational metrics that do support some level of premium valuation. The company is performing well.
Exactly. Wall Street analysts are positive, the stock's up 26% year to date, and historically, it's been a massive winner. A stock split just makes it more appealing to a broader investor base.
But, and this is a big but, we have to talk about the valuation. The price-to-earnings ratio is an astronomical 465. That is not just high, it's priced for absolute perfection and then some. The stock is also trading very close to its 52-week high. While the business is strong, such an extreme valuation means any minor miss on growth expectations or content performance could lead to a significant correction.
So despite the good news and the split excitement, you're saying the price has gotten ahead of even that strong growth. It was also rated stay away last month.
Precisely. The KPIs, particularly that PE of 465, suggest that the market has already factored in an extraordinary amount of future growth. For new investments at this level, the risk is simply too high. So, for NFLX, despite the bullish sentiment and strong company, it's still a stay away from our perspective today.
2 stay away so far. Let's move on to Nebius Group, NVV, ticker NBIS. This one's interesting, Brooke. Users are cautiously bullish, expressing a strong long-term belief in its role in the booming AI sector. They see it as undervalued or oversold right now, talking about major contract wins and impressive 2027 ARR targets. There's a lot of conviction, with users even DCAing through this bloodbath, hoping for a rebound. Some are even tying its future to NVIDIA's performance.
And that's exactly where the caution comes in, Ethan. While I appreciate the long-term vision for AI, we've seen NBIS rated a speculative gamble just last week, and even buy and cautious buy before that. But looking at the current KPIs, my perspective hasn't improved.
What are the numbers saying this time?
Well, the PE ratio is still incredibly high at nearly 98, which already prices in massive future growth that frankly isn't reflected in its current financials. Its operating margin is still negative at minus 0.89%, meaning its core business operations are losing money. And for a company with such a high PE, its revenue growth rate is only 3.55%, which is strikingly low. We also saw news of dismal Q3 earnings recently, which explains why users are calling it a bloodbath.
So the community's optimism about future potential and contracts is clashing hard with the current reality and recent performance.
Exactly. While there's potential for those KPIs to improve if those contracts materialize and AI demand truly accelerates, the current financial state does not support such a high valuation. The risk is simply too great right now, especially with the upcoming NVIDIA earnings adding broader market uncertainty. Given the extreme valuation, low revenue growth for that valuation, and negative operating margins, it's a clear stay away for us today, which is a downgrade from its recent speculative gamble rating.
All right, tough calls today, but the numbers don't lie. Let's recap. Investigate as buy. None. Investigate as cautious buy. None. Investigate as speculative gamble. Nebius Group, NVV, NBIS.
And that wraps up our daily hunt. Remember, the market is constantly evolving and information changes fast.
This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset.
Thank you for joining us on the Daily Hunt for Multibaggers.
We'll catch you next time.